Welcome to All Things Finance. In this video, I will be talking about bond valuation. So, the value of bonds can change substantially over time, hence the need to closely monitor their values. But first, let us first define what is a bond. A bond is a long-term debt security issued by governments and corporations to raise capital. As I've mentioned earlier, the value of bonds can change substantially over time, so there is the need to closely monitor their values. So how do we know the current value or price of the bond? Bond valuation is the method used in determining the price or value of the bond. The appropriate price of a bond reflects the present value of the cash flows to be generated by the bond in the form of periodic interest payments or coupons and the principal payment to be provided at maturity. Therefore, the price of the bond is equal to the present value of interest payments plus the present value of principal repayment. In issuing a bond, you have to consider two types of interest rates: the coupon rate, which is the rate that is stated in the bond or the bond indenture, and the effective rate, or the discount rate, or the opportunity cost of capital. I say an opportunity cost of capital since this is the rate that can be earned in an alternative investments of equal risk. Sometimes a bond is sold less than the face or par value, and sometimes it is sold more than the face or par value. So when do these things happen? When a bond is sold less than the face value, it is said to be sold at a discount. It happens when the effective interest rate is less than the coupon or stated rate. So effective rate is less than coupon rate, you have a discount bond. When a bond is sold more than the face value, it is said to be sold at a premium. This happens when the effective interest rate is less than the stated or coupon rate. So effective rate is less than coupon rate, you have a premium bond. There are also times that a bond is sold equal to its par or face value. This is when the effective and coupon rates are equal. So effective rate is equal to coupon rate, you have a par bond. To summarize, the price of the bond when it's sold for less than face value, you have a discount. That is when the effective rate is greater than the coupon. And you have a premium bond if the effective rate is less than a coupon and is sold far more than the face value. Going back to the formula of getting the price of the bond, which is present value of interest payments plus present value of principal repayment, remember that in a bond, the issuer is expected to pay the bondholder periodic coupon or interest payments. It could be annually or semi-annually, depending on the agreement. The coupons are the same all throughout the entire term of the bond. So say, if it is a bond with a face of $1,000 and the coupon is 5% per annum, it means that the issuer must pay $50 to the bond every year as a form of interest. The coupon or interest payment is equal all throughout the life of the bond. It is an example of an ordinary annuity since it is paid at the end of each year. So in order for us to get the present value of all the interest payments, we will be using the present value formula of an ordinary annuity. So that is present value is equal to the function payment times the function 1 less 1 over 1 plus I raised to the power of n all over I. Here, the PMT is equal to the coupon or interest payments. Other than the interest payments, the issuer is expected to return the original principal back to the bondholders at the end of the maturity period. The payment of the principal is an example of a lump sum payment. In order for us to get the current price of the bond, we must also take into account the present value of the lump sum principal payment. So, we use the present value of a lump sum formula. So the formula is equal to the face value or the par value times 1 plus I, which is the effective rate, raised to the power of negative n, where n is the number of periods and I is the effective rate, and the PMT, the FV rather, is the face value or the par value. Therefore, the formula in solving for the price of the bonds is PMT times 1 minus 1 all over 1 plus I raised to the power of n all over I plus the present value of principal repayment FV times 1 plus I raised to the power of negative n. So I present to you the 5 steps in solving for the value of the bond. First, we convert interest rates and the repayment periods. Second, we calculate the coupon or the interest payment. Number 3, we calculate the present value of interest payments using the formula. Number 4, we calculate the present value of the principal using the lump sum formula. And number 5, we add the present values of both from steps 3 and step 4. So example, on January 1, 2020, Lazada Incorporated issued $1,000 bonds at a coupon rate of 10%. At this time, the market is selling these bonds at 12%. This bond must be paid back by January 1, 2030. Interest is paid semi-annually beginning June 30, 2020. At first glance, we can already see that this bond is selling at a discount because the effective rate is 12% is more than the stated rate of 10%. Also, the maturity period lasts for 10 years, since from 2020 to 2030 is 10 years. And we have to take note that the payment of the coupons are done semi-annually. So first, let us convert the interest rates and the payment periods. So our coupon rate, which is 10%, and since it is done semi-annually, we divide it by 2, we have 5%. And for effective rate, since our effective rate is 12% and we divide it by 2, that's 6%. For our payment periods, our 10 years, we will multiply it by 2 since it is done semi-annually, so we have 20 periods. Next, we compute the interest payment. So our coupon rate, which is 5%, we multiply it with the face value, that's 2 million. That's 2,000 times $1,000 bonds, that's $2 million. So our coupon or interest payment is 100,000. Number 3, we compute for the present value of interest payments. So having all of the data, we just supply it with inside the formula. So PV is equal to the 100,000 times the function 1 minus 1 over 1 times 1.06 raised to the power of 20 all over 6%. So we come up with a figure 1,146,992.12. Next, we compute for the present value of the face value. So that's PV times 2 million times 1 plus 0.6 raised to the power of negative 20. We got the figure $623,609.45. Ultimately, we add both the present values and we acquired the price of $1,770,601.57. So, indeed, it is selling at a discount because it is way below the face value of $2 million. Let's have another example. Here, the same conditions except that the market for the bonds is selling at a rate of 8%. So first, let us convert the interest and repayment periods. Our stated rate stayed the same, so we still have 5%. Now, our effective rate has changed, which is now 8%. So we computed it, we divided it by 2, now we have 4%. And since the maturity period did not change, we still have 20 periods. Next, since our interest payments does not change, so we still have $100,000. Then we compute for the present value of interest payments. So our PV is equal to 100,000 times 1 minus 1 over 1.04, the new effective rate, raised to the power of 20, all over 4%. So we got 1,359,032.63. Next, we compute for the present value of principal payment. So present value is equal to 2 million times the new interest, the new effective rate of 1 plus 0.04% raised to the power of negative 20. We got 912,773.89. So the new price of the bond in the new market effective rate is equal to 2,271,806.52. So this time, the bond is selling at a premium because it is selling way above the face value of 2 million. So to summarize, we have this table. So our coupon rate is fixed at 10%. When we had the effective rate at 12%, our price was at 1,770,601, which is below the face value of 2 million. So it is said that we are selling at a discount, or it is a discount bond. In the second sample, our effective rate changed to 8%, so our price also changed to $2,271,806.52, which is above the face value of 2 million and is said to be selling at a premium, or is called a premium bond. Here, we can observe that the effective interest rate has an inverse relationship with the price or value of the bond. As the effective rate increases from the coupon rate, the price of the bond decreases. Meanwhile, as the effective rate decreases from the coupon rate, the price of the bond increases. Thank you so much for watching. If you like this video, please click like, subscribe, and share to anyone who are interested in bonds. Happy investing! Till next time!